Have you heard the news? President Trump just dropped a bombshell, sweeping tariffs on countries around the world, and yes, Singapore wasn't spared. Economists are now warning this could trigger a global recession, and if that happens, it could shake up your job, your income, and your dreams of buying a home. So if you're planning to buy property in Singapore, you need to pay attention now. In today's video from Wealth for You, we're breaking it all down. What are these tariffs really about? How will they impact the global and Singapore economy? And most importantly, what does this mean for the housing market, both condos and HDBs? I'll also share what homebuyers like you should watch out for, and the precautions to protect yourself in this uncertain time. So do this before we dive in. Like this video, subscribe to Wealth for You, and stay till the end, because this might be the most important housing update you'll hear this year. Let's get into it. Part 1. What are tariffs and why it matters? Let's start with the basics. What is a tariff? A tariff is like a special tax placed on imported goods. Let's say a French winery wants to sell wine to the US for $50 a bottle. If the US imposes a 10% tariff, the importer now pays $55 for that same bottle. That extra cost? It gets passed on to consumers, you and me. So while Trump says he's punishing other countries, in reality, it's American businesses and consumers who pay more. Now here's the catch. Trump's new policy slaps 24% to 49% tariffs on most Asian countries. Even Singapore got a 10% tariff, the lowest bracket, likely because we import more from the US than we export. But China got hit with a massive 34% tariff on top of an earlier 20%, which was subsequently adjusted to a total of 104% after China retaliated with 34% tariff on US imports. Part 2. Global domino effect. So what happens next? Prices go up across the board. Food, tech, raw materials, everything. People cut spending. Businesses earn less. And that's when the real trouble begins. Stock markets crash, the worst since the COVID-19 pandemic. Companies start to lay off staff. International trade slows down. This could spiral into a full-blown global trade war. China, Canada, and the EU are already planning their own countermeasures. Australia even called the US move not the act of a friend. Even PM Lawrence Wong has warned us, we are entering a new phase, more arbitrary, protectionist, and dangerous. Singaporeans must brace for more shocks. Part 3. How Singapore will be hit. Now let's talk about Singapore. We are a small, open economy, highly dependent on global trade. Here's how tariffs and a global slowdown will hit us. Higher unemployment risk. Multinational companies here may freeze hiring or cut jobs. If their US or China operations suffer, Singapore gets hit too. Job seekers, fresh grads, even PMETs may find it harder to secure work. Tourism takes a hit. Regional countries hit harder by tariffs will cut travel spending. Fewer tourists mean hotel, F&B, and retail industries will be affected. Inflation risk. As a country that imports almost everything, Singapore will see prices rise. Tariffs mean higher cost of goods, leading to more financial pressure on households. Port and trade disruptions. Our shipping industry may also slow down due to reduced global trade volume. All of these directly or indirectly affect our housing market. Part 4. What happens to the housing market? Now let's bring it closer to home. What does all this global chaos mean for property prices in Singapore? Well, imagine this. The condo owner's dilemma. You're a young couple in your 30s. You stretched your finances to buy a private condo 3 years ago. Maybe even bought a second one to rent out, thinking prices will keep going up. But then, the recession hits. Suddenly, your company starts retrenching. Your tenant, an expat working in tech, gets sent home. Rental income dries up, and your monthly mortgage becomes harder and harder to service. You're not alone. In a downturn, this is exactly what happens to thousands of private property owners. People lose their jobs. Rental demand drops as foreigners leave. Developers slash prices to clear unsold units, and some owners are forced into fire sales or foreclosures. Analysts are already forecasting potential price corrections of 10 to 20%, especially in the luxury and investment segments. Investor confidence fades, speculators hold back, and suddenly, the once red-hot condo market starts to cool, fast. And now, let's switch to the HDB scene. Meet Jane and Marcus. They're newly married, but couldn't get a BTOQ number. So what do? They head to the resale HDB market, like thousands of others who can't wait 4 to 5 years for a flat. At the same time, ex-condo owners who sold at a loss are also looking for cheaper alternatives. After their 15-month wait, they too start looking for resale HDBs. And suddenly, demand starts rising. Here's the twist. While private condo prices are falling, resale HDB prices might actually hold steady or even go up slightly due to this surge in demand. Why? Because HDB is a basic need. People will always need somewhere to live, especially during tough times. But wait, not all HDBs are safe. Let's not sugarcoat it. Some HDB owners may still struggle, especially those who lost jobs and can't keep up with mortgage payments. But here's the good news. If you're using an HDB loan, you're not alone. HDB has support schemes, from payment deferrals to stretching your loan term. If you're struggling, the worst thing you can do is stay silent. Reach out early. Get help. So whether you're in a condo or a flat, this recession will test everyone. But the key is knowing your risks, protecting your finances, and not making rash moves. Part 5. What should home buyers do now? If you're planning to buy a home in 2025, here's my advice. Don't rush into a condo purchase this year. This is not the year to FOMO into new launches. Prices may look stable now, but the global recession is still playing out. Wait and see how the market shifts. There may be better deals ahead. Build your emergency fund. Save 6 to 12 months of expenses. If retrenchments hit your industry, this buffer will buy you time. Consider HDB over condo. If you must buy now, consider taking an HDB loan. HDB is more forgiving than banks if you run into financial trouble. Diversify your income. Start a side hustle. Now, food delivery, freelance on Fiverr, real estate license, home baking, affiliate marketing, YouTube channel. These can help buffer your income if job loss happens. Don't over-leverage. Avoid overstretching your loan. Just because the bank approves it doesn't mean you should borrow the max. Closing thoughts. Look, I'm not here to scare you, but I've seen enough downturns to know that the ones who stay calm, prepared, and informed always come out stronger. The world is changing fast. And if this global recession plays out the way many expect, it won't be the biggest earners who survive. It'll be the most disciplined, cautious, and ready. So stay smart, stay safe, and most importantly, stay ahead. If you found this video helpful, give it a like. And don't forget to subscribe to Wealth for You for more real talk on money, property, and staying financially sharp in uncertain times. I'll see you in the next one.